The data is in for Canada's home sales in 2024. And you might actually be surprised on how much home prices actually rose last year. Also, the latest inflation print has come out this week, and it came in at the second lowest reading that we have seen in 46 months. Plus, we have an update on even further slowing housing starts and intel on how much the rate of new mortgages are actually increasing. Let's dive into what is important in Vancouver real estate this week. Starting off, Canada's 2024 real estate data is out, and as mentioned, home prices rose. Home prices on average across our nation were up 2.5% last year, increasing to $776,640 on average. Now, when we break it down by province and territory, every single region in our nation saw prices rise except for one, which was Ontario. Ontario was the outlier, seeing home prices drop by 1.7%. The largest gainer of the year was the Northwest Territories, which ripped 35% higher last year, followed by New Brunswick at 15.5% and the Yukon at 12.8%. Our province in British Columbia, well, we ended up 5.9% overall, with the remainder of the provinces increasing between 2.3 up to 9.4%, which was Alberta. We are going to post the chart here on YouTube so you can see exactly how much prices rose in each region across the country. But back to Ontario for a moment, right? This is the one province that saw prices drop on average. And we've been talking about how troubled the pre-sale and newly constructed condo price correction has been over there. I mean, pre-construction condo sales hit a 28-year low in Toronto last year. I mean, that's low. And we're not talking about being adjusted for population growth either. That's just a 28-year low overall. And of course, the amount of newly completed condos are hitting the market at what is now, I believe, an all-time high in active listings in that area. Understandably, prices are dropping in that segment of the market, with sale prices registering 10, 15, even 20% or more in some cases for some of these condos, lower than their original purchase price. They're flooding the marketplace, and sellers are basically undercutting each other. It's a race to the bottom for those. But again, when we pull back, I mean, Ontario overall didn't do that bad. I mean, the horror stories that you hear all, week in and week out lately, you think the whole province was experiencing a housing crash, but it's not, right? Again, the average home price in Ontario dropped 1.7% last year. That's manageable by most standards, I would think. And it illustrates part of the theme of this episode, right? The stories of these mega losses, well, they're real, but they're kind of an exception. I mean, it's a big exception, but you get what I'm going at here. I mean, I could just as easily share stories about somebody who lived in Point Grey and sold their house for $5 million more than what they paid for it. They just had to live in it for 25 years. Both stories are true and both are somewhat outliers. And ultimately, neither probably affect you, right? Unless you're the person in that Point Grey house or you're the one who maybe owns an investment condo that just completed in Toronto, then for sure. But ultimately, the grandiose wins and losses within real estate, they always make for great stories, right? Every time that the assessments come out, well, we always hear about how much Chip Wilson's house is worth, because why? It's the biggest number out there, right? It's just an interesting story. But they're often just that, right? They're stories, right? And what really matters here is what's important to you. And by that, I mean being aware of how hyper-local real estate markets are. For example, I've got a client here in Mount Pleasant East, and they reached out saying that they're thinking of selling their half duplex. But they had also heard that the market is down around 7% since the peak in 2022, and they ideally want that good old peak pricing, as so many sellers do. Well, I looked up the data for half duplexes in Mount Pleasant East. They're actually at an all-time high today. Right now, prices for that property type in that area are the highest they've ever been. They're actually 7% higher than the March 2022 peak, right? Because the peak is for pricing for all of Greater Vancouver and all property types as a whole. Half duplexes in Mount Pleasant East are obviously in their own category. But what's equally important to know is that if they were selling a condo in that area, well, those are below 2022 peak prices by about 3%. And if they had been in a detached home, those are down 9%. since that 2022 peak. So it really shows how important it is to obtain hyper-specific data on the area and property type that you are going after or that you are selling. I mean, you could even have, you can look at a half duplex on that's like, the full, maybe completely finished front back duplex, so it's obviously the same building. And yet one half, even though it's identical square footage, could be 40,000 more than the other half. Why is that? Well, maybe it's because the back half is south-facing and a lot of people prefer the south-facing, and those typically will sell first, right? So that's how hyper-local it is. You could even buy the same half building, that same square footage, same age, same everything, and spend 40K more being back or front. So again, this is all about being super informed for exactly what you're looking to do, because even in a very small region, you can see home prices radically different compared to just what type of home they are.
Really interesting point, Dan. And actually in December, I'm pretty sure we sold the most expensive half duplex in Mount Pleasant East that's ever been recorded. So there's that as well. With that being said, very interesting that you note, single family homes being down 9%. And I think condos 3%, probably due to supply with the condo side and affordability on the single family side. And you're really finding that mixture, that desirability for that missing middle piece. I mean, that demand is there. That's why the price is higher. So it's very, very interesting data, and you're spot on with it being hyper local, because it's individual markets that produce these results. But seeing as we're going to talk about CPI here, because we're going to step back, go back up to 30,000 feet and look back. One little caveat. I'm in my bedroom because I'm quarantining here. I've unfortunately got COVID, but nevertheless, let's have a look here at the newest inflation print that came out this week, because it registered at 1.8%, and this is lower than December's reading of 1.9%. In fact, it's the second lowest reading we've had in 46 months. Only September of 2024 was lower, hitting 1.6%. So inflation has now been within the BOC's target band for 12 straight months. And the shelter component continues to cool as mortgage interest costs have dropped from 13.2% down to about 11.5%, marking the 16th consecutive month of deceleration. Similarly, rent has gone from 7.7% down to 7.1%. And I think you could expect this contribution to the CPI basket to continue for the next 3 months or so. What does this latest CPI data mean for next week's BOC's call? Well, especially as we're coming off an unexpectedly high employment reading the week before, where 44% of that was actually state-driven employment. One way to look at this is the Bank of Canada's neutral rate, the range for interest rates where they don't have to stimulate or restrict economic growth, is between 2.25 and 3.25%. And today we're on the higher end of that range, with mortgage costs clearly still a key factor driving inflation higher ever since the Bank of Canada started raising rates back in 2022. However, when we actually take that component out, inflation comes in at just 1.3%. So we take this perceived look because mortgage interest costs are a drain on consumer spending power, rather than a true source of demand-based inflation. So while shelter costs are significant, it's important to recognize that the other 70% of pricing factors, the other 70% of the basket, have now been tracking below 1% inflation since last August. Even with strong employment reading last week and the threat of tariffs, the markets are pricing in a 0.25% cut next week. And they've been on a roll lately, meaning the markets have been right. So the likelihood of that carrying on seems high. This will bring the overnight rate down to 3%, and that's the lowest since August 2022.
So with interest rates lowering, we are starting to see people get more interested in buying homes again. And that data is reflected in the new mortgage originations, right? People buying homes with a mortgage, these all register. So the total residential mortgage debt across Canada, it rose 0.5% in November. That's $10.5 billion is how much that 0.5% moves that needle, with a total of $2.25 trillion in mortgages across our country right now. Monthly growth was notably higher than the 0.3% seen last year and has been hovering, 0.4, 0.5 since May of 2024, which notably is the month that preceded the central bank's first rate cut. So even with the overnight rate at 5%, we started to see an uptick in mortgages, new mortgages, right at the tail end of that 5% era. Over the past year, households have generally been taking on mortgage debt at a faster rate. The annual growth rate came in at 4%, or about $86 billion in November, and that marked the third month in a row of accelerating new mortgage originations. It's now at the highest level we've seen dating back to June of 2023, and so it clearly appears that the appetite for mortgage debt is returning. But of course, do note that it's still much lower than the 5-year average, which is 6.6%. But seeing as we are now at 3 straight months, basically a trend, and we're going to basically see a rate cut happen next week, and we're at the beginning of the spring market. Plus, I'll share the amount of activity Ryan and myself and our team and our colleagues are all discussing and seeing and experiencing right now. It's elevated, And it started early in January too. Like I hate the term busy, but we're active right now, and a lot of our colleagues in the industry are talking about how incredibly active they are, including our favorite mortgage specialist over at BMO. He is leading the country again already, and has done more mortgages than anybody else in BMO nationally. And he's just absolutely saying that expect a whole bunch of work to come your way because the mortgage originations are starting. Right, people are getting their pre-approvals in place now. So what am I saying here? It does look like the trend of new mortgages will continue its upward trend for at least the next few months here.
Yeah, let's not forget, this is a cyclical motion that we go through this time of year, right? It's not surprising to see that. I think it is surprising, maybe sort of the volume at which we're dealing with right now. We've got quite a lot of inquiries taking place, a lot of people who maybe pushed off 24 that are back in the market in 25, albeit they've got lower rates, they've got more to select, more inventory to look from, and that will continue to climb over the next few months. So I definitely think you're going to continue to see higher levels of motivation, higher levels of activity well into late spring. I don't, and there's a few other potential cuts that could land there, although I'm betting we're going to see those later in the year. For now, let's look here at housing starts. So new homes being built continues to draw lower. We've been talking about this for feels like months, maybe even years now. Housing starts fell 13% in December, month over month, and they are down 8% year over year. There were some outliers to mention. Compared with last year, year-to-date starts were up 28% in Kelowna, while being down 15% in 15% in Vancouver and 16% in Victoria. Starts hit 231,000 in December, 90,000 lower than the recent peak in March of 2021. While above long-term averages, starts have been on the decline for 4 years. So that's actually a long time we've been talking about new housing starts on the decline. It'd be nice to see that turning around here.
Yeah, don't expect a turnaround anytime soon, and people aren't really feeling this too much yet because, of course, there's so many completions taking place, right? I think nationally we're very close to an all-time high in completions about to take place for this year. But as the starts continue to drop, and as things like mortgage origination start to pick up, there's going to be some tightening of the marketplace, but it might take years, right? It might take till 2027 or even beyond that. But again, you can see where things are trending, and the trend is what's important to pay attention to. So keep an eye on housing starts for the next 4 years, because if those continue to trend down, well, you know what happens as population might start to pick up again too. Now, lastly here, we are very excited to announce that next week we have the chief economist from the Bank of Montreal joining us. Mr. Doug Porter is back, and we will be discussing the BOC's rate announcement, whether there's a cut or no cut or a hike. We'll talk about that. We're going to get deep into the economics of Canada and kind of get his vision for what's going to take place in the housing market in 2025. Super excited to have him back. It's going to be a really good episode, so we look forward to sharing that one with you. For now, I think we'll cut it a bit short today to let Ryan rest up and be on his game for the Doug Porter interview. So thank you, as always, for tuning in. Have a great week, and we will see you here next Saturday.